Imagine driving a car on the road. Okay, just imagine you are in a car on a road and you don't know how to read stop sign. You don't know what a green signal means, what a yellow signal means, what a pedestrian sign means. What's going to happen? You're going to run into accidents sooner or later, right? I see people doing the same thing when they invest in the stock markets. Many of them, they don't know the meaning of EBITDA or return on cash employed or cash flow conversion cycle and many such basic financial concepts. And they invest mainly just based on their understanding of what other people are saying and just trying to follow them, etc. So I thought I will make some videos in which I will explain whoever needs help in understanding basic financial concepts, in understanding and analyzing income statement, balance sheet, cash flow statements, financial analysis of these things, not from the perspective of an accountant, but from the perspective of a financial investor. If you're investing in a company, or if you're running a company as an entrepreneur, or if you're investing money in somebody else's company, a private company or a startup or a friends and family company, you should have the basic financial knowledge of understanding and analyzing these things. So with that, let's dive into what are the main financial statements of a company. A company's performance can be represented through three financial statements. One of them is called, the first one is called income statement, but it's also called profit and loss statement. Okay. It simply represents what is the amount of profit or loss that the company made over a given period. The period could be 1 year, 5 years, 1 quarter, which is 3 months, 1 month, 1 week, whatever it is. Second is balance sheet, which means what are the assets and what are the liabilities of a company as of a given date. Okay, so let's say it's December 31st, 2021. And as of that date, these were the assets of the company and these were the liabilities of the company. That's what a balance sheet is supposed to represent. Last is cash flow statement. Cash flow statement is supposed to represent what are the cash inflows and outflows of a company for a given year. So let's say for the year 2021, from January 1, 2021 until December 31st, 2021, this was the cash that moved into the company and this was the cash that moved out of the company. Now, how is it different from a profit and loss? A profit and loss is supposed to record, this was my revenue of the company, as we'll see a little bit later on. And these were all the expenses of the company. It could be cash expenses, could be non-cash expenses, and it mainly takes an operating view of the company. Okay. Whereas a cash flow statement can have items that are operating in nature, right? And that also it has things of financing in nature. Company raised some money, took some debt, company has some capital expenditure, okay, like building plant, machinery, etc. So it shows a true cash inflow and outflow. That is why a cash flow statement is separate from a profit and loss statement. So now let's have a look at the profit and loss or income statement of Apple Inc., one of the largest companies in the world. As you can see in front of you, the first line is revenue. This is simply the revenue that Apple earned in the last financial year, which ended on September 25, 2021 for Apple. It's a slightly odd ending date. Most companies in the US will have December 31st as their year ending date, but Apple for some reason has this date in September that keeps on varying by a few days here and there. So the 2021 fiscal ended on September 25, and Apple had a revenue of $365 billion in that year. Second line item you'll see is cost of sales, which means, let's say Apple sold iPhones and other things, and one iPhone cost them, or one iPhone was sold for $1,000 and they got it made in China. Okay, so what was the actual cost of that item, of that iPhone to Apple? If the actual cost was, let's say, $600. Okay, so then that is the cost of sales. It's also called cost of goods sold for Apple. So that you will see is recorded as $213 billion. Okay, so when you subtract revenue, when you subtract cost of sales from revenue, you will get what's called gross profit. So in case of Apple, gross profit last year was $152 billion. Okay, and there's something called gross margin, which is simply you take gross profit and divide that by revenue. And what you get in terms of percentage is gross margin. So for Apple, that was 41.8% last year. So what you've seen, so we're going to go from on the income statement from top to bottom. You've seen the first couple of lines here, and now let's move down. So after gross profit, as you can see on your screen, we just went through the first couple of lines. The next are operating expenses. So operating expenses, for example, in case of Apple, the first one is research and development. So in last year, that number was $21.9 billion. That's what Apple spent in terms of R&D. The second major expense for Apple was selling, general and administrative. It captures various things, and you can find this if you go through Apple's annual report. They will disclose what exactly it captures. But essentially, in this case, selling is their advertising expenses. General and administrative will capture things like the corporate expenses, head office expenses, and so on and so forth. So those are the other operating expenses, right? Or SG&A, what's also it's called in short. So when you subtract these operating expenses from gross profit, okay, what you get is something called operating income. So for Apple, the R&D expense was 21.9, and coincidentally, last year even the selling, general and administrative expense was also 21.9. So the operating income is nothing but you take the gross profit and you subtract these operating expenses, and what you get is $109 billion. That was Apple's operating income last year. There's another term for operating income. It's called EBIT, EBIT, earnings before interest and taxes. The reason for this term should be obvious. Earnings is nothing but profit. That so far we have deducted cost of sales or cost of goods sold. We have deducted research and development. We have deducted selling, general, administrative, but we have not deducted interest expense, and we have not deducted taxes from the net profit, right? That is why it is called EBIT, earnings before interest and taxes, or operating income. Is the same thing. And when you divide EBIT by revenue, what you get is something called operating margin, okay, or EBIT margin. Is simply EBIT divided by revenue. Now let's talk about a term that you might have commonly heard if you invest in the stock markets, or even if you run a company. It's called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So let's see what it is. So in case of Apple, we've just seen operating income, or EBIT, right, which was $109 billion. We add back something called depreciation and amortization to it. I will come to it in a moment of what it is. But for a moment, let's just take it and we add it back. In case of Apple, it was 11.3. So when you add 11.3 to 109, you get 120.3, which is EBIT plus D&A, or depreciation and amortization, is EBITDA, which is 120.3. Now let's step back and see what is D&A and why are we adding it back. So depreciation and amortization is nothing but an expense. Let's take an example. So let's say you have a company and there's a machine that has been bought for $100 million. So now there's a one-time cash outflow, which you will see on a cash flow statement of a company. You will see a one-time cash outflow of $100 million in that year. Let's say the machine was bought in 2021. But now that machine is, let's say the shelf life of the machine is 10 years. So that machine is going to last you 10 years. And so you have a choice. When you look at the profit and loss statement, what you can do is you can say, okay, I'm going to incur a cost of, instead of incurring a cost of $100 million on my P&L in 1 year, which will really reduce my profit substantially, right? I'm going to take $100 million of cost and divide that by 10, which is a 10 years of shelf life. So I get $10 million. So I will expense $10 million in year 1, $10 million in year 2, $10 million in year 3. So I can have a more normalized view of my true profit and loss in the company, rather than 1 year being artificially very low and then other years being very high, right? So that's what you're doing. But keep in mind, second, third, fourth years of first, second, third, fourth year, as we are putting a charge of $10 million in each of the years, what's actually happening is that the cash expense has already happened. So now that you're putting this as an expense item in the P&L, it's actually a non-cash expense, right? Because it's not like you're paying $10 million every year. That's not cash flowing out of the company. That's already happened in year 1. So which is why it's a non-cash expense. Now, why are we adding it back? We're adding it back because EBITDA is supposed to be a proxy for a company's operating cash flow. Okay, I'll come to that again in a moment. But let's step back, get to EBIT level, earning before interest and taxes. This can have both cash and non-cash expenses, right? So when you go from revenue to gross profit and gross profit to operating expenses, the operating expenses can be cash and some of them can be non-cash. And one of the major ones that is often there in the non-cash item is depreciation and amortization. Okay, so that is why we're saying let's add back any non-cash charges or non-cash expenses. So we get to something called EBITDA, which will show us the real operating cash flow of the company. What has happened in terms of cash, in cash income and cash expenses. So that is why we add back and we get this term called EBITDA. Now, why are we calling it a proxy and not the real cash flow? Because EBITDA, first of all, as I told you, there are some other cash and non-cash expenses going from revenue to EBIT. So we've not added back everything. We've added back D&A because it's the most common one and the biggest one for most companies. Okay, and there are some smaller ones that we can talk about in a more advanced video. And then secondly, there are other cash expenses involved in day-to-day operations of a company, such as working capital, right? You can have working capital, inventory, receivables, payables, cash movement because of that, which is not captured in the income statement. It is captured in cash flow statement. Okay, which is why we're saying that EBITDA is a rough proxy for a company's operating cash flow, but it's very helpful because when you're looking at a company on a intuitive basis, just to understand, taking a bird's eye view, asking what's the EBITDA of the company, it helps you understand, okay, this is the rough cash flow of the company. That's how much cash is producing, while knowing that's not accurate, but at least it gives you some sense of what's happening. So that takes us from revenue, gross profit, EBIT. We add back D&A to understand the importance of EBITDA. Let's move on now to the next slide. Now let's continue down the income statement, right? We've gone from gross profit to EBIT. Now from EBIT, if you go down and you subtract income expense, interest expense, okay, then you'll get profit before taxes. Now Apple is a bit of an anomaly that Apple is a very cash-rich company. So instead of having debt in the company and then having an interest expense, Apple actually has cash in the balance sheet or cash in the company and they earn interest income. Okay, which is why you have to add the income for Apple. So if $109 billion was the operating profit or EBIT, then we add, and in case of Apple, the earning from interest or what they call other expenses / income is actually other income, not expense in case of Apple, was 0.3. So you add back, you take 109, you add back 0.3 of other expense or other income, and you get 109.3. Again, remember, because Apple has an interest income, not an expense. But in a typical company, you will see debt and you will see interest expense. So you would have had 109 minus 0.3, which would have given you 108.7 if 0.3 was the real interest expense. So just keep that in mind. In case of Apple, they have interest income rather than interest expense. So EBIT minus interest expense takes you to profit before tax, PBT. And that's what the number you see on the screen is 109.3. Then you come towards the bottom of the income statement. So you take PBT, profit before tax, and then you subtract the taxes for the company. Okay, and the tax for Apple was $14.5 billion. So just remember, in income statement, the tax that's shown, some of that is real cash tax that's paid that year, and some of that could be non-cash tax, which the company will pay later on. But just for accounting purposes, a company is supposed to maintain whatever cash is supposed to pay on that income, whether they pay it right now, whether they pay it later on. If it's later on, it will be captured on the cash flow statement. That's why we need the separate cash flow statement, because profit and loss reality in terms of cash flow is different from the actual cash outflows of a company or inflows of a company. So coming back to income statement, right? You take profit before tax and you subtract all the taxes of the company that is supposed to be paid for that income for that year. And then what you get is something called profit after tax. Okay. Or it's also called net income. Okay. PAT or NI is the same thing. In case of Apple, you take 109.3 of PBT, subtract tax of 14.5, and you get profit after tax of $94.8 billion. And in terms of margin, right, PAT margin or net income margin or net margin, they're all the same thing. You simply take the profit after tax and you divide that by revenue of the company and you get 25.9%. Okay, so that was the net margin for Apple for last year. Here you're seeing the full income statement of Apple represented in one shot. You can see from the top, you've got revenue. We subtracted cost of goods sold. You got gross profit. You got something called gross margin. Then you have operating expenses of the company, right? R&D, SG&A. You get to EBIT, right? Here we're not adding back D&A. That was just to show you the concept of EBITDA. But normally you would not see a separate line for EBITDA in an income statement. Sometimes you might, but otherwise you don't really see that. Then you subtract interest expense. In case of Apple, we're adding it back. You get profit before taxes. And then you take tax, subtract tax, you get to profit after taxes or net income. So that's the concept. That's in a nutshell an introductory analysis of an income statement. Hopefully this was helpful to you. In the next video, we will talk about balance sheet, how to analyze the balance sheet of a company. If you like this video and if you'd like to receive more of such videos, then please feel free to like and subscribe to this channel. And then I will see you in the next video talking about balance sheet. Take care.